You see the S&P ending the year lower than where we are now, and yet we've seen catalyst after catalyst shrugged off by markets. What do you see as actually driving the markets to where you see them at the end of the year?
Yeah, well, thanks, Lisa. I mean, look, I think it's pretty straightforward from where we sit that a lot of good news has been baked in. I don't think that's an out of consensus view. People know that. Where we're getting a little bit more concerned for the index levels, that the expectations now for next year are actually higher than what we think is achievable on earnings. And that's the first time that we've been able to say that since the recovery began. We've been consistently above where the consensus is. And now we think the consensus is baking in too much optimism, particularly around margins, not only from an operating standpoint, but also ignoring the fact that taxes are likely to go up next year. So that's sort of reason number one. The second reason is that we are into this mid-cycle transition, as we call it. We're moving from kind of early cycle recovery phase to more mid-cycle. And whenever that happens in any economic recovery, Lisa, the price earnings multiples come down because the market knows that we're past the peak rate of change. And we think there's about 15% downside to the multiple. So the combination of probably estimates that may be kind of full and valuation that looks also above where they should be, that leads to a 10% downside from here between now and year end, roughly 3,900.